Ladies and gentlemen, welcome to the Daily Capital Flows live stream. We have a day where equity markets are ripping higher, the yen is falling lower, and there's some really interesting news that I've been watching coming out across the tape in terms of more deals going through in the entire AI space that is, again, continually misunderstood by the market. The fact that equities are ripping is an indication right now that people are not bullish enough. And when we look at the underlying factors, when we look at the data behind things, not just try to take a narrative and wrap it around whatever our bias is, when we actually look at the underlying data, what we can see is that liquidity is expanding in the underlying system. And when you begin to understand that and start from there, then you'll be able to see all the second and third order effects across equity markets. And what we are seeing right now is people taking small pieces of data and extrapolating it to the whole. They have a bad experience, they have something that doesn't go their way, and then they begin to think the entire system is having the same experience that they're having. And so, if you were here at the Capital Flows daily live stream, as a reminder, every single thing here that we're doing every single day, we're streaming every single day, 11:30 a.m. Mountain Standard Time or Pacific Standard Time right now, hour and a half before cash equity close. The entire live stream is built for risk takers. So if you're just the type of person that's trying to sit back, eat some popcorn, and not think very hard, you're probably not going to enjoy the live stream as much. But if you're someone who enjoys challenging and pushing yourself, taking risk in markets, and actively trying to find asymmetric bets and home run trades, every single thing that we are doing every single day is structured around that because that's our goal. And so the type of analysis that we're going to do every single day is covering the largest factors in markets, which are macro factors, to understand recession risk, inflation shocks, macro liquidity, and the credit cycle turns so that you walk away with a clear understanding of rates, FX, and US equities. And that all empowers you to make very clear capital allocation decisions. So, bottom line, if you're responsible for risk and not just opinions, then this is going to be incredibly helpful for you. It's built for you. And the thing that we're going to cover today in the free macro playbook section is about this idea on the equity risk curve. And I titled, if you're wherever you're watching this, if you're watching this on Twitter, I'd really appreciate it if you're able to retweet it so that people are aware. And then if you're watching this on YouTube or on Twitter, I see all the comments. So you guys can put comments in the comment section, provide any insider perspective so that we're able to touch on the different questions or thoughts or context that you guys give us about where you guys are coming from so that we're able to just, I think, hit home a lot of the points in specific circumstances. So today I titled the live stream, The Factor That Will Force Traders to Buy Equities. And the reason why I started there is because there is this prominent theme in markets that liquidity is contracting, that everything is overbought, that equities are sitting at levels not seen since entering whatever period of time. And what I always do is take a step back and say, okay, let's look at the underlying forces and the data behind these different factors and begin to build an informed conviction and edge about not what just we think is happening, but what is actually happening in the underlying forces. And so the entire free playbook section, we are going to cover today macro from first principles. So we're going to talk about the equity risk curve. Why is it that some traders might be forced to buy equities? What actually is driving markets? And how is the structural regime developing? And then by using that, we'll be able to filter a lot of the false narratives that come in. And that's really going to help us set the stage for reading all the data. And so the net result is you'll be able to have a complete read on the macro backdrop. And then if you want to take those elements, synthesize them in real time, and then connect them to where we're at markets, then the paid subscriber section is going to be the place where we can do that. So every single thing will be streamed on Twitter and YouTube, where you guys are at right now. And then the paid subscriber section will be only on Substack halfway through. But before we jump into equity flows, equity sectors, we have a special guest today, which I'm excited to be able to chat with because he also runs a live stream that I really enjoy watching. And he has a really unique view and vantage point in financial markets, not just in terms of the people he gets to talk to every day, but I think that he has the mindset and spirit of risk taking that is really what is going to define a lot of not only just media, but also markets as we're moving into this next period of time, next decade. So I have Andy from the Roll Up. Andy, thanks for hopping on and joining us. Appreciate you coming on. I'm going to bring him
sir.
up.
Let's
What
go,
is
boys.
up,
How we
Andy?
doing?
Good.
You
How
get
are
paid
you
to hold
doing?
risk. You know what I mean?
You get paid to hold risk. You
Yes,
get paid to
sir.
hold risk.
Yes,
It's not
sir.
complicated. How are you doing, brother?
I'm good, man. Just hop off the show today. I somehow just snagged 2 World Cup tickets for the game here in New York at 5. So I'm absolutely stoked on that.
What a legend.
Yeah,
Just getting tickets here and there.
Yeah, that'd be good. Yeah,
I love it.
How are you guys doing?
We're doing great. You know, we've had a lot of really interesting stuff. I know James and myself have been trading a lot of different interesting things this past week. And I just feel like we have this momentum, not only in markets, but just like life as we're heading into the 250th celebration for the 4th of July for the, not unapologetically.
America is on a heater. We are on a heater in America right
100%.
now.
Listen, how long was the Roman Empire around? I feel like that's going to pale in comparison, okay? Everyone's like, oh, maybe we're not going to be as long. And I'm just like, why don't you go over there and sit in the corner, buddy? You know, like we have so much upside and we're in the greatest country in the world. This is the best time to be alive.
Yep.
And I, welcome all the cope in this comment section that just kind of reflects the view that people have on life that don't
Yeah,
live in
man.
America. But hey, it's okay. I don't make the rules here. I'm just here
And
playing the game.
look, he's in the city that has the most momentum right now. I don't know
Yep.
about politically, but it has the most momentum with energy and vibes and all that right now. So how does it feel to be there in New York?
Yeah, it's good. I'll show you guys real quick. If you hit there, you can see the view behind. It should work. And yeah, I mean, it's great. We're in the Empire State Building. It's a beautiful day out here. I've got my yerba mate. Just did the show, and it's sunny. Helicopters flying. Finance is financing, and we're bringing it on chain as well. I'll tell you that we're bringing it on chain. So this is the view, guys, and thanks for having me.
Dude,
What's that? What's
I
that
love it.
mean? Bringing it on chain. What is that?
What does
Yeah.
that mean?
What does
Yeah,
that
I
mean?
mean, we are. I mean, so I've been laying out that this kind of tokenization, stable coins, and perps are. We are vastly underestimating just the size of these markets. I mean, obviously, it's a bear market in Bitcoin right now, and people are really worried about Sailor. But we've just been seeing simultaneous news, partnerships, announcements, and developments across tokenization, stable coins, and perps that are just absolutely mind-numbing. And so when I say bring it on chain, I mean we're in this kind of process right now of there's so many assets in the world that could benefit from better rails, 24/7 capital markets, global distribution. And the process to do that is to tokenize these assets and to bring them on blockchains. And so I'm just been seeing this as like the most compelling trend since the inception of DeFi itself in 2019, 2020, where I think a lot of us in this space, and just a quick background, I run a markets and digital assets show. We're live. We interview founders, investors, et cetera. And so we have a very interesting purview into what's happening. And basically, we're just in this kind of tipping point right now where a lot of the traditional finance, asset managers, funds, firms, banks are realizing that these simultaneous trends of tokenization, stablecoins, and perps are accelerating very they're just pouring fuel on the fire. And so the thesis here is that there's going to be this migration of assets that are basically denominated in off-chain ledgers via brokerage accounts or trusts or in deeds, and a lot of these are going to be ported over on chain, and they will still obviously exist off chain, but the on chain denomination of them uh, will be tradable, will be collateral. We'll have this ability to operate in a more efficient, seamless 24/7 kind of setting. And so that's what I mean. I mean, all of these guys down here, down south, just 30 blocks of me, a lot of them know it, a lot of them don't, but a lot of what they're doing right now in the future will be on blockchains. And so it's something to be excited about amidst the kind of depressed crypto market. And then if you look at some of the crypto assets that are doing well, obviously you guys are big hype and Purbles, Lighter's doing well, a couple spot dexes, Aerodrome's doing great. A lot of these assets are performing because the market is realizing that they're kind of what is going to be the future of futures trading, of spot trading, of lending, of credit. And so there's this very early transformation happening, and it's going to be a multi-year, decade-long transformation with big guns like Larry Fink behind it. And it's just something that is really, really exciting. And so tokenization, stablecoins, perps, those three are exports of this industry of digital assets, and they give you a shining light of hope amidst the kind of a sailor, denominated bear market that's happening.
Dude, I like how you're putting that, and I also love you got to talk more about the roll up and everything you guys are doing in the live stream, because you guys have been, you guys have helped definitely us a lot in pulling some of the stuff that we have together for the live stream, and you've been a big help for that. But I feel like you guys you're taking a bet that most people like aren't even thinking about taking, because they view like the entire crypto market as one thing, and they're like, well, Bitcoin's going down, so why would I start a network or a business or something inside the crypto space? Whereas you guys have just been kind of full sending it on everything and really niching down to those themes that you're talking about. And I feel like all the people you had on have been like so dialed to all of those themes and building those themes. But like, what has your mindset been around that type of bet that you're taking and the framework you have for that?
Yeah, man. I mean, this is our third bear market, Robbie and I. So we've been running the show for 6 years, but really just got into the streaming and doing things daily and going live and really kind of creating this format about a year and a half ago. And it's been, I mean, right now it's really just finding pockets of outperformance and opportunity and things to be optimistic about. I find that in media, the the worst thing you can be in a bear market, especially, is just one of the pessimists. Nobody wants to listen to that. Nobody wants to hear about that. People want to believe. People want to form theses around ideas that are early. And I genuinely believe this kind of like three-headed beast here is the confluence of like a lot of the effort that's gone into this industry. And then we've seen it. We put our money where our mouth is. Like we've been, big hype bulls, big lighter bulls, big bulls across various asset class or various assets in crypto, various sectors. And we like to like have our own capital in our theses, talk to the people that matter about them, reform them, shape our worldview, and then kind of readjust. And so I don't know, man. You get paid to hold risk. You get paid to start a business when you're in a risky early industry. And I don't know. I don't know what we would do without this, man. This is like so much fun, and crypto's 24/7. And I know we have massive upside. And so our job is just to come online every day, adjust our thesis, make sure that we have our positions set in the best way possible, and continue to just kind of reframe ideas, grow, and then have the community that's with us, similar to you guys, to grow alongside us. Here's our positions. Here's what we think. Here's what we're doing. Trade with us, invest with us, fade us, whatever it is. Just kind of like this like mastermind forming of like people that are trying to outperform this bear and then thus crush the next cycle. And so that's how I think about it.
That's a great answer. And to piggyback on flows here, it's like I'm really impressed, first of all, how you guys seem to source everybody at the right time. It's like it's one thing to like understand the timeline and the zeitgeist of the moment, but then to get the people on who matter in the things that are actually doing, like that's a whole nother thing. We don't really focus on that too much, right? It's a little bit more education based or whatever. We're not bringing on a bunch of people. We're only really kind of wanting to bring on the people that we feel like are like important to us or we want to highlight or whatever. So how has it been like being able to interact with all the people that matter, especially to the things like you believe in and you matter? Like what are people missing about the space and the way to take risk moving forward? And like what is it that like why are you so excited and why is everybody else not so excited? You know what I mean?
Yeah.
Like what is filling the gap there? Is it because you're shaking hands with the people and boots on the ground and like what's missing in that gap to get us back to the next level?
Yeah, man. I mean, it does help a lot to speak with the builders. Like the traders and the investors are like the hottest thing in the bull markets, but they kind of like tend to fade out in the bear because they have to be objectively bearish and they have to kind of like trade the charts. Whereas the builders, they don't trade the charts. They're just building. They're just like, we are building the future of finance here. We're going to bring all these assets on chain. We're building next generation technology. We are technologists at heart. We believe in it. And so it's really just that. It's like when you speak to the people that are in the trenches, not in the, on chain, meme coin trenches, but in the, we raised a ton of
Shout
money
out to the Black Bull.
the
Shout out to
Black
the
Bull,
Black
right?
Bull.
And so it's just like, they are price up, down, sideways. They don't care. They're building every day in and day out. And so we take these like more like longer term mega trend outlooks to the space where it's like, look, your job in the bear is to save as much drawdown as you can. And if you can make money, then great. And obviously, we've gotten somewhat lucky and taken risk this bear, and we've had some outperformers with the names that I've named. And so it's been a pretty good bear for us. And so now it's just about, okay, the mega trends are here. Don't fuck it up. How do you not fuck it up? Well, you don't blow yourself up, you survive, and then you talk to the right people at the right times. You figure out what's actually happening who's actually doing well. You ask them like real questions about, you know, what they're building, who's using it, who the adopters are, and then you just use that information to kind of continuously hold a optimistic view and understand where you are in like the broader macro trend of this specific industry, which is we're in year 15, we're in year 10 of smart contracts. It's like, I mean, these are going to be perpetual technologies. I'm 26, so it's like,
Whoa, brag, brag.
like, what are we doing
Ja-
here being bearish, guys? Zoom out.
James is 46 and he's already just pushing the edge.
I look like whatever a bear market in crypto is. That's
You're a good
I
golfer,
just
though. I'm
look
sure, man. I'm sure you kick my ass.
You'd be surprised how bad I am.
Andy, talk to me a little bit about how you have kind of been able to be in these worlds. I think especially in New York. New York has kind of blown up to a bit more of a tech hub over the last couple of years, I feel like. And there's a lot more interesting people there that are, I think there's a shift in how people think about risk taking, especially with the younger generation. And this kind of pitch that people get of like, oh, well, just put your money in CDs, and then if you really want to do something insane, go to the S&P 500, and maybe you'll get 7% a year. And that has kind of been the traditional narrative that we get over and over. And now we see things pretty dramatically changing because everyone recognizes that if they want to get from the bottom K to the upper K, they have to be concentrated, take aggressive risk. And the world is changing so much where now the asymmetry that exists allows you to go from making not a lot of money to, if you really swing for the fences, all you need is a couple bets to turn out right. And you've made, really significant sums of money. So how do you think about this new atmosphere of risk taking and kind of just pushing back on this argument of people are saying like, oh yeah, these kids, they don't get it, they're just going to get washed, and they'll eventually come around or something like that, as opposed to like, no, there's actually a step up in basis in the environment that's taking place. Like, how do you think about that?
Yeah, man. I mean, I have no 401k. I have no IRA. I haven't had a real job W-2 ever. I've always just thought about it as like when I first started kind of looking at investing, the S&P was, I don't know, like 3K, 4K. You zoom out, you look at the chart on the NASDAQ and the S&P, and maybe it was silly back then, but I'm like, dude, like housing prices at all-time highs, stocks ripping all-time highs. Our parents basically have just amassed this massive amount of wealth, and housing is way less affordable than ever. Rent is expensive. Stocks are expensive. A lot of investments are expensive. Like, how am I ever going to catch up to anybody else who had the opportunity 30, 40 years ago, given the inflationary environment and given all the kind of like context I just laid out? And then you look at crypto, and it's like this very early asset class. And, that was kind of like the aha, where it's like, oh, this is finally a chance to be into something before the big bankers or the big banks get into it, before the institutions are into it, before all these other kind of allocators who are always first opportunities were in it. And so that was like the first like, whoa, like flipping moment. And then you hit like a couple wins where you like, I bought ETH around like 100 to $200 back in 2019. That was the first time that I learned about like what you're saying, which is like concentration and then like bets. I was like, I basically full ported it, and it was like, went to 5,000, and it was like, wow, this is crazy. And obviously you round trip 75% of it, but still, it's like, whoa, this is insane. What happens when you actually take risk in markets and allocate in size? And so when I think about like traditional methods, and I think about the context of like what our generation is faced with, we're faced with the most unaffordable set of circumstances ever. Meanwhile, we're also faced with the most like digital first, like, I guess, understanding of culture. Like there's just a new way of narrative investing, of thinking about assets. There's a new way that our generation thinks about the world and how to allocate capital. And it's not the same 60-40 playbook. It's not the same kind of saving CD S&P playbook. It is aggressively more risk on because of the dynamics that the world has presented to this younger generation and to the generation under. And so Look, the way that I think about it is opportunities where I have edge in knowledge and in conviction. And that typically for me comes in the form of spot trading in crypto assets that I believe are fundamentally sound and have a potential to make a strong return over 3, 6, 12 to 18-month period. And that has been the bread and butter. And that'll continue to be the bread and butter. And everything else, I almost just like stay away from it. Like I found like when I try to get into like commodities or into certain equities or into trading other asset classes, I don't know. I just don't perform as well. So that's kind of like my outlook, and that's my personal experience and kind of context on like where our generation is at and how this generation is thinking about markets.
I think that's great. And I think you guys are a good example of like what maybe an aspirational younger person should think about when it comes to betting on themselves. Not that they have to go create a financial media company, but you said, all right, here's our situation. Here's what I can control. I don't want to take the cookie cutter way. How could I go and leverage my skill set, which is being a yapper? Like you're a yapper, right? Like you're a good quality yapper, and how can I leverage that in a space that I like and solve problems for people for people by like bringing them the news that they're answering the questions and feelings that they're feeling in the moment every single day dependably is kind of your bet that you're taking. But I think it's a good example of like how the youths could approach the future here and thinking about that in their own perspective, right? I mean, that's what we're trying to do is like we really thought deeply about like where is this space going? You know, is Substack growing? Yeah. Is financial media growing? Yeah. Is the arc of the retail trader becoming from going from seen as stupid to actually seen as like an outperformer, and like where could you fit on that, and where do like your personal attributes help along that curve?
Mm.
And that's why I think I like what you guys do is like it's not easy to do, right? You guys have to show up there every day, talk about stuff, even when you refresh your portfolio in the mornings. And I'm sure sometimes you throw it in your pillow and you're like, the last thing I want to do is walk over to the Empire State Building right now and log on and talk about like,
Uh,
privacy coins.
yeah,
Like,
I'm like texting Jay. I'm like, Jay, fuck, man, hype, man, dude. It's a $200 asset. You need to understand. And I'm like, Jay, fuck, it's just so
yeah,
funny.
yeah, no, I mean, I think what you're doing though is like a cool new age thing that's aligned with a growing niche and place, and I think that's what we're trying to do anyway. And I know you got to run here soon, so I just wanted to say I think you guys are doing a fantastic job. I hope we can do more together in the future. And Flows, if you have any more questions for Andy
Yeah, and
before he
just one
runs,
quick
let me
thing,
know.
Flows, is James. I feel the same. You guys have such a. I tap into your streams almost daily, just 5-10 minutes, quick segment, and it's like, whoa! It's like I know nothing about markets. I know nothing about how liquidity, like manage the mental perceptions, the emotions, and so the niche that you guys are filling is extremely, extremely important for the day to day of investors. It's also quite scalable as a business framework and a very niche from that perspective. And so, I mean, the PowerPoints that you guys do are insane. I mean, it's just you guys are machines. And so, I truly think that the space is going to get massive. I think that this is like the precipice of this new age of media and finance. I also think that we're at the right intersection of investment technologies and thesis. And so, yeah, I mean, kudos to you guys, and I really appreciate you guys having me on.
Dude, we appreciate it. I think that at the end of the day, if people are generating so much value that they're making so much money from all of the content that anyone is putting out, people are going to always come back. And that's the entire goal. Is like if you're adding so much value to someone else, then you're able to actually tangibly impact their lives. And I always like to think about it as like, just be an operating expense in someone else's life. And like they're going to make so much more money just because of that one investment, that one operating expense. And I just think it's awesome because there's there's so much there's so much potential in the new world of risk taking that we're in. And I love that like all of these conceptions about retail, institutions, like how you should really structure your portfolio. All of these things are just kind of falling by the wayside. Like I talk with financial advisors all the time now, and they're like, maybe we should really rethink this and like how we're really structuring this portfolio.
Yeah.
And they're realizing like things are changing so fast, and the biggest risk you can take is by not participating, by not getting into the game. So
Yep.
appreciate you coming on, man. I appreciate you being in the game, and I know we'll do another one of these again sometime soon, and we'll be on each other's shows. Everyone, if you guys haven't yet, go to the Roll Up and go to their Twitter account. Go to Andy. I just reposted it. Seriously, don't know how you got that on Twitter, the ANDYYY.
Just kept typing Y's until it worked.
Yeah, exactly.
Is that what happened?
Exactly. Guys, are we sure Capital Flows isn't like a robot? Or is there any proof of humanhood? Has anybody ever seen this guy?
Allegedly, I've met him.
This guy's just like an
allegedly.
AI encyclopedia for liquidity, apparently.
James,
I think you're right.
James just created an AI, and I'm
I
the
said,
corpus
I
of
said,
knowledge.
Claude, make the right curve version of me. That's what it was.
You guys are a great duo. I like to think Rob and I are as well. We have fun. That's how you don't burn out in this game. Each and every day you come and have fun. That's the only thing I'll leave you with, you guys. So thanks for having me.
Last question. It was from a comment in the audience. Maybe it was me. Who is taller between you and Robbie? Who's the tall one?
I am taller for sure. Rob's like 5'11". I'm like
Let's
6'3". Yeah.
6'3". Oh, man. The
Unbelievable.
view is good up there. The view is good.
You guys are something. Well, guys, I'm going to the World Cup. France versus Sweden. I think France is going to take all their money, but I'm going to go see Mbappe. Should be an amazing game, knockout stage. This prediction market hooked it up with some sweet seats, so I'm stoked.
Dude, post your bet so we can get in on the action, and we'll bet on your bet. Okay.
Let's go. You got
all righty, guys.
I'm sure you got that free bet. All right, we'll talk.
Cheers, you guys.
Okay,
Much love. Bye.
All right, we're back.
We're good?
Yep.
All right, awesome. Let me just pull this up. We're good to go. All right, everyone, thank you for being here. I love chatting with Andy, man. He just has such like the energy that he brings to every situation is like the glue that makes ideas come together. You know what I'm saying?
Right.
It's just awesome.
Yeah.
All right, cool. Well, everyone, thank you for joining the live stream. We have a lot to cover today in the equity side of things. Why exactly equities are rallying when we're told that they should be collapsing. But I want to actually start by building on something that Andy said and that James laid out a little bit more. And it's this idea of risk taking. And I start with the idea of risk taking because, you know, I actually posted this video the other day where this guy was like, oh, why in the world would I try to get, 7% or 9% in the S&P 500? I want to double my money. What in the world is going on? And I think that what people have to realize is not just in the sentiment and in the mindset of, I would say basically anyone under 25 now, 25 and under, I think it's, even 30 and under, every single person recognizes that risk-taking has fundamentally changed. You can't just be a passive participant in the economy, hope for the best, and say like, oh, well, I'm going to get a house one day. I'll do this. I'll do this. I'll do this. Right? Like there's now this overwhelming force that is putting downward pressure on real wages. We know that. And is providing outsized returns to risk takers and people who are building equity. And the reason why, people say like, oh, well, everything's benefiting the top 1% because they hold all the equity. Well, think about it. Why do they hold all the equity? People hold equity not just because they happen to have held it, right? Like the majority of wealth that has been created by the top 1% is not inherited wealth. It's the most ridiculous thing that people could say. It is equity because people took risk. The whole point of equity is that you took the risk and you actually worked to build that equity. And so whatever you're doing, the period of time that we're moving into is there is a lot more people building equity and actively taking risk. And the type of returns that worked in the past don't work these days. And there's a reason why the S&P 500 has had above average returns over the last 5 years. You can't just write that off and say like, "Oh no, it's just, it's a unique period of time, whatever it might be," right? Like that doesn't work anymore. You have to actually ask harder questions and say, "Hey, all of these changes in robotics and AI in space that we talked about yesterday with Adam Rossi, all of these factors are culminating together where if you're not taking risk, that's the larger risk to you." And I'm going to actually switch to Twitter really fast because here we go. Because the thing that I laid out the other day was that, or I laid out this morning, was the factor is this title, the factor that will force traders to buy equities. This is the title of today's live stream. And I said, people don't realize that traders can be forced to buy equities or they will lose their job. And people said, no one can force you to buy equities. Oh, really? When you show, in a hedge fund trader and PM shows up at the trading desk and the CIO of the hedge fund says, "Why are you underperforming if you don't underperform over the next year?" And maybe they'll say it in a nicer way that is less domineering. But hey, if you don't, make returns this year or this quarter, you're out. We're booting you. You're going to lose your job. You're not going to get your profit split. And so they will benchmark and be more aggressive to say, I have to outperform the benchmark. And so they will buy equities, not because they're like, oh, well, this fundamentally is going to do incredibly well, but because they have to actually take risk. That's one of the factors. On top of that, when you have this equity risk curve, which we're going to talk about in a moment, corporations are forced to take out debt or they'll lose market share. People think that, oh, as long as you don't take out any debt and as long as you run the Dave Ramsey playbook, you're going to be fine. Well, that doesn't really work for corporations when your growth rates are in excess of 100% and your competitor, if they grow faster than you for the next 2 years, they will be able to basically squeeze you out of the market and underprice you. And within 4 years, you'll be gone. Right? Like it doesn't matter. You say like, oh, well, just wait till the recession comes and then we'll, clean up. Yeah, that doesn't matter if the company sweeps you up in the interim. And so everything has a time frame component that you can't ignore. And so the corporations in the market are forced to take out debt. You know how many corporations right now are forced to take out debt? And people are saying like, oh, well, they'll frame it as a strategic decision, but all of these companies need to take out debt to keep up with all the AI invest. And then companies are forced to pay for AI or become irrelevant. There are constraints in the system. And one of the very clear constraints, let me go to the recent photo that I posted on this one, Digital Realty to buy Blackstone stake in 3 data centers. These types of news events are coming out all the time now where Digital Realty agreed to purchase a 64% equity interest in 3 Northern Virginia data centers from Blackstone, affiliated funds for 3.5 billion, including 1.2 billion in cash and 2.3 billion in Digital Realty shares. If you don't know, I've been covering this on the website for, on the Substack. I mean, comprehensively. We actually talked about data centers and all these warehouses in Virginia actually yesterday with Adam Rossi. And if you guys haven't watched the live stream from yesterday, go to the recording of that and begin to understand how data centers in Virginia, all these other larger things with space, the American Industrial Revolution that is literally getting reindustrialized right now, how all of those factors are coming together. And so when you have something like this where they're spending 3.5 billion and they're using their own shares and 1.2 billion in cash, these are all indications about the amount of money in the system and the earnings that are backing them. Because even on this, if it was just diluting shareholders, then the stock would be down so much more and it would be a issue. And so these really come to this larger picture of how should we think about this macro regime. And so I know a lot of people have kind of been asking, okay, how do we think about the larger macro regime as it relates to equities, Bitcoin, hyperliquid, other bets that I'm taking, like Oracle and things like that. And what I want to do for a moment before we hop into the slide deck is break those down a little bit. And I think these are important because you'll begin to understand why it's taking place and how to think about it. So let's start with Bitcoin. We're going to talk about Bitcoin a little bit more in the paid subscriber section. But what I will say first is that Bitcoin has not provided enough disruption in the space to outperform in this cycle. That's been very clear. The main outperformer has been Hyperliquid. And if you were in the paid stream yesterday, you kind of know how I'm thinking about the catalyst for Hyperliquid, which again, no one is really talking about. But the biggest bet that I have had year to date is that Hyperliquid is going to rally even if Bitcoin falls. And people say, like, oh, well, Bitcoin's falling and it's dragging on Hyperliquid. Okay. Yeah, there's 166% we're up almost year to date in Hyperliquid and we're down in 35 in Bitcoin. Has it dragged it down on a correlation basis? Sure, but notice Bitcoin is making a series of lower highs and lower lows. But what's Hyperliquid doing? Making a series of higher highs and higher lows. And that is really the indication about where we are in the cycle right now. There's a divergence taking place, which sends you information. Now, a lot of people have been asking about how this connects, how Hyperliquid connects to these changes in PER, which has been the biggest bet that I've taken. And so let me lay that out for you. Let me pull up this chart because everyone wants to know the main thing that everyone wants to know is how exactly should you think about PER here and its performance. So let me pull up this chart so you can begin to understand that. Oh. And this will all connect back up to the liquidity cycle, the credit cycle, and everything else. So first, when we start laying out PER and Hyperliquid and everything along those lines, since the merger where we had the final acquisition go through and you had PER become, a really the first treasury company. Whoops. What took place is that PER was the only place to be able to get exposure in the financial system or in the traditional financial system to Hyperliquid. And I've been laying out the entire PER thesis and really Hyperliquid thesis since sub 350 in PER and then also in the low 20s for Hyperliquid. During this time, what took place is we rallied, and because of the access issue, you had a pretty significant outperformance in PER previous to some of these ETFs being launched. And one of the things that I noted was that, listen, with these ETFs being launched, there are still a lot of elements where PER, as a company, Hyperliquid Strategies, has the ability to outperform. And what we have seen on net is that when PER is trading at a premium to NAV, they sell shares, and on the bottom, they actually buy them back. So they're selling shares on the upside, buying them back on the bottom, on the downside when we're trading at a discount to NAV. And that on net is helping provide more exposure to PER on a float adjusted basis. Now, what people have begun to wonder about is, okay, if I can buy an ETF that tracks Hyperliquid, why would I buy the treasury company? And then stack on top of that, you have some warrants coming out as we hit these strikes. And by the way, the warrants are all layered up on different prices, so they're not just at one price. So, but you have warrants that are going to come out and they're going to add more shares to the float. And so people are saying, why in the world would I actually hold PER over an ETF? Why would I do that in this kind of environment? And here is the two ways that I would think about that. Number one is that first, for PER and for its expression, I think that when you own as a company 10% of the float of Hyperliquid, which is more than any of the ETFs, that's pretty significant in terms of their ability to have optionality in the entire system itself. So number one, we know that Hyperliquid Strategies PER has an advantage simply because one, their stance related to trade XYZ, they're actually able to stake a lot more than regular ETFs because ETFs need to provide liquidity. So that's one. But also, they have a connection to Trade XYZ, which is the largest launch provider of perps on Hyperliquid. And what I believe we have is the potential for Hyperliquid strategies to be able to, if the leadership decides to really be more aggressive, is one, begin to add value through other avenues with because of their holdings with the Hyperliquid token, which what we're going to see in the next earnings call is if the leadership of Per decides to do that. If they, and people are saying like, oh, well, it's hard to have a gamma squeeze or it's hard to have some type of squeeze or some type of other issue, or I'm sorry, for it to outperform when they're always issuing shares at the money. And what I would say about that is that I would agree with you if they weren't buying back shares. So if they're only issuing and then buying, right, that can still be accretive. But when you buy back shares on net, that creates more fundamental value for the stock to actually realize more future returns and potential for future returns in their overall stock price. Now, what I would say is that all of this is coming down to the leadership of Hyperliquid Strategies. I continue to hold Per. It's my largest position. And, we're up really significantly. I think, Hyperliquid and Per are going to have a massive run still. I think that we're in the very early innings of that. I don't think we're in the late innings of that at all. And what I believe is that if the leadership of Hyperliquid Strategies begins to take a more dominant stance in the market by being a unifying factor in a decentralized world, because Hyperliquid fundamentally is decentralized. It's one of the reasons why they have so many issues actually getting into the US regulatory framework is because they're actually a truly decentralized protocol. If you talk to any of the guys uh, connected directly, whether it's on the Hyperliquid side or Trade XYZ or any of the people that are launching protocols or products or whatever that might be on the Hyperliquid blockchain, if you talk to them, you will recognize how difficult it is to actually build in a decentralized way because communication is very fragmented. Partnerships with people so you can have a whole that's greater than the sum of the parts is very challenging. And you're going to have a lot of challenges just being able to get liquidity in the places that it needs for early stage products. And so we don't have a unifying force that can function almost as a type of connection and also, I think, a venture type portfolio, or also be able to use the base that they have to collect premiums in the market. Because if you have a base of assets, that gives you optionality to be able to collect other premiums without getting liquidated, whether that is selling puts or whether it's doing some type of strategy with puts and calls, or if it is anything related to lending or whatever that might be in terms of the Hyperliquid side, if people want to be able to short it or borrow against it or use leverage to trade it. And so I think if those deals are structured properly, there's a lot of optionality for Per to provide excess returns. And I think especially on the VC side, because there are so many things that are taking place on Hyperliquid right now that need really strong unifying leadership. And if you have a centralizing force be able to provide that leadership, then they're going to be able to not just benefit from the Hyperliquid token itself, but from the entire ecosystem as a whole. And they don't even need to take that much more risk in their underlying tokens. And so that's one of the key things that I think is misunderstood by the market because an ETF provider, they can't do that. Think about it. An ETF, all they can do is collect assets, buy and sell, and do nothing else. They don't have a role over those assets where they can take specific risks around them. And we've already seen that Hyperliquid Strategies has executed their strategy for selling and buying back shares in a really significant way. And so the price action that we have seen, I think it's caused some people to have some caution, and I think that's valid. You should be asking hard questions about why is this underperforming? How should we think about this? What in the future is the expectation about how leadership is going to provide value in excess of ETFs. And what we're going to see, I think, in the next earnings call over the next couple of months is the leadership of hyperliquid strategies need to make a decision about what that's going to look like and how they're going to begin to implement a strategy to do that. And if they're just going to, here's what I say too. If they're not going to do that and they're just going to say, oh no, we're just going to buy shares, when they're at a discount and issue them when they're at a premium and collect a spread and, maybe we'll outperform at the end of the year or something like that by a couple percent, something like that. And then, we can be a really liquid alternative to different ETF products. And then we also have a tradable float, which, by the way, you're not going to have a gamma squeeze in an ETF. You're only going to have a gamma squeeze in a low float stock, which is again another reason I'm long per. And I've said this so many times. People for some reason don't really want to like take it to heart. But even if they're issuing money at the shares when we're at a premium, it doesn't mean we can't go higher because there is a limit to how much they want to issue shares. There's always a limit, not only in historically their own execution, but also there is a limit because they actually have warrants for shares in the company. So they're not incentivized to go beyond a certain point. So that means that when you have the average daily volume of the tradable float and that begins to be in excess of the dilution that takes place from the warrants, once that begins to take place, especially on a hyperliquid rally, the only thing that is going to have a gamma squeeze is per, not the ETFs. And so you have that embedded call option and optionality on the upside. Stack that with if leadership of per decides to take a more dominant stance in the market and capitalize on probably one of the greatest opportunities in financial history, where we're having perps begin to get launched and they can be a really centralizing force in that world. That is going to dramatically change the view of per. And the other thing that I would say is that people are a little bit too bearish on the warrants and like that they think they're going to totally change the float or like basically crash the stock or something like that. It's a little absurd in terms of if you look at how much we have for that. And I doubt that if they're going to sell shares at the same time that they're going to have these warrants turn over and basically have these new shares into the market. I doubt they're going to sell shares as well unless we go into a full gamma squeeze. So what I would say is that I would expect people to kind of misunderstand some of these factors, especially as it relates to hyperliquid and the potential for hyperliquid, because people are thinking about hyperliquid as, oh, well, it's just this kind of protocol that people look at on Wall Street, and maybe it'll work here and there for SpaceX, and maybe it's kind of cool, and we'll see what happens. I mean, people have no clue. People misunderstand hyperliquid on a fundamental basis. And the reason why is because they don't understand how you need a pricing mechanism in markets that is not impacted by by a centralized player. And on top of that, you can have a place where you're pricing all of these perps and now tokenized assets in a new way. And, I'll lay out more of the catalysts for how I'm thinking about that in the paid subscriber section. But what I would say is that there's a lot of things that people still fundamentally misunderstand. Because if you ask your average Twitter bro or CT bro or whatever it is on what they think about hyperliquid, all they know are the vibes. They don't really know anything else. Oh, they're like, well, hyperliquid has a cool UI. That's it, right? Like that's your value proposition. Right? Like, it just shows how much that people don't understand the actual mechanism of hyperliquid, its role in macro liquidity, its role in the global financial system, especially if you get some new derivatives on there that are not really priced as aggressively or have as much volume as in other places. So I think that all of those factors stack to show the world that we live in right now and to say, yeah, for me right now, if my view changes, if there is some significant change in per or something like that, I'm going to be the first one to say like, okay, well, you know what, my view has changed, and I'm going to change my positioning, and I'm going to do something else. I'll always do that because my entire goal is to make returns in markets, whether that's on a 1 year time horizon, a 10-year time horizon, or a 30-year time horizon. It doesn't matter, right? But breaking those down and saying, okay, listen, on a one month, 3 month, 6 month time horizon, if we see more confirmation from leadership in per, that is going to be very positive for the ecosystem overall. And so that's one of the things that I'm looking at. And if we start to not see that, and we don't see confirmation of some of these other factors, and you have a ton more money, basically taking advantage of these vol premiums and things like that, then maybe there is an argument to shift. But what I would say is there's more that's misunderstood about hyperliquid and per than there is priced in about an most optimistic scenario. So that's one of the things I would say. James, I know we kind of data dumped a bunch right there, but what would
Yeah, I have some stuff for you.
All right, shoot.
uh, what one thing is I have two main points here. One, what do you think when it comes to how they own a large percentage of the current float, right? Is it like 11 or 12% or something like that?
Yep.
If you think, I was doing some math on strategy, like if you assume strategy has 850,000 Bitcoin and that there are only like 16 million coins in existence, they have about 5.5% of the float. And you're seeing how much of an impact like strategy has on the overall ecosystem. You know what I mean? But they also have leverage, right? And I don't believe that it's the same case here. So I wanted to just know, like, as they grow, they're an integral part of the hyperliquid ecosystem. They have this um, validator set with Trade XYZ. They have all this experience. They can issue shares, but buy back shares and accumulate hype over time. What does this large float percentage mean in the grand scheme of things? Is it less about credit stress that could occur and more about like warrants and dilution cadence, or like how do you see that huge number being of importance or not?
If you have, here's a long term view that really is the biggest factor. If Hyperliquid Hyperliquid already has elements of being a monopoly, and they have the potential to turn into an even bigger one. Hyperliquid, in terms of like compared to Binance, is like I think like less than 1% of the volume, or maybe 1% of the volume. It's like nothing. Hyperliquid has at baseline, Hyperliquid has a very reasonable and I would say high probability of flipping Binance in terms of volume. Would not be surprised. I would definitely say getting up to 50%. I think that seems very clear. But when you have a monopoly and that monopoly is decentralized, owning, let's say 10 or 20, let's say 10% of the float, 12% of the float, whatever. Owning 10% or 12% of the float is so much more valuable in a monopoly when it's decentralized. If it's centralized, then like it doesn't really matter as much because you have like these voting shares and all this other stuff, right? But if you have, Hyperliquid become even a larger monopoly, and you already have one player that owns a very significant majority of that, that totally changes how exactly you can have it really, edge power dynamics in the system, how exactly they can, take those tokens, whether it's investment protocols, or use them to be able to just be able to make more decisions in the decentralized ecosystem overall, and literally set the trajectory of the ecosystem. So I think that's one of the biggest elements that people miss. And ETFs just don't have the ability to do that because ETFs, by their inherent one nature in terms of the financial structure, and two, the unbiased nature they're supposed to have, in terms of how they use those tokens. Uh, ETFs are pass through vehicles. They can't make strategic decisions. They can't try to operate in the ecosystem and say like, oh, you know what, we're going to make these decisions over here, back these people, or bring awareness to this new protocol so that liquidity comes on. I mean, if you just think about, if you own 10% of the float, you could just simply with that run a VC fund for everything on Hyperliquid that doesn't even eat into your actual tokens, right? Like you can just literally fund it with awareness and be able to, bring attention and liquidity to the highest quality projects on Hyperliquid, and that will allow you to, you know, really make exceptional returns. So, I think that there's so many ways that exist to differentiate yourself, and there's very little downside when you have a capital base like that.
Okay. The second thing was, this idea that, oh, there's these warrants and there's this dilution that occurs when they're at a certain MNAV or whatever. My thoughts to that are, the simplest way to put it is like, when I'm trading and if I'm in like an order book or something like that, if you have enough pressure to the upside of anything, it basically doesn't matter the size of the player that's in there. The market is going to pummel through that and either accelerate or find its way to the next like resistance level or whatever. And when I think of like the warrant steps up, right? I don't remember where they end. Maybe it's like, is it up to like $14 or something? Or does it go higher than that?
I think there's like a couple that go a little bit higher than that, I believe.
All right. Well, let's just
Yeah.
say, like, I'm just trying to think of like the possibility of something that
Right.
leads to the gamma squeeze, right? And to me, that's a few things. Bitcoin catching a bid, right? Reclaiming 64, 65K. Um, Strategy, reclaiming a little bit of their credit stress issues that they're doing. And then you have Hyperliquid, we have the Clarity Act, which, by the way, if we look at this right here, you can see that the Clarity Act is not looking great right now. It's at a 39% chance, and it's only, I think it's a 3 weeks away, 2.5 weeks away from the
Yeah.
vote. And like, this to me is setting up an inflection point here where if this keeps going lower and there's no progress here, you're going to see Bitcoin make that next leg lower and not be able to just get its foot off the ground, which then I think adds to the strategy stress. And I don't think Hyperliquid, as much as I like it, will be able to sustain the power if the rest of the ecosystem were to fall. But if it were to go up in Clarity Act percentages, Bitcoin were to catch a bid, strategy were to catch a bid, both sentiment wise and price wise, and Hyperliquid, which has been showing insane resilience, starts to go up, I think it's at that point where it could make all-time highs. And like, if Bitcoin were starting to bid, it makes all-time highs. And then you're going to start seeing PER go through all of those strikes. But because of the momentum of the rest of the market, like when I think of an order book and I think of all of these sell walls of warrants that maybe they do, maybe they don't, and even the dilution when they decide to, the momentum to the upside, the volume that will be going through will basically break those. And once you get on the other side of that wall, that's where you have the crazy optionality and chase to get out of the like short pressure, if you will, the covering move, which leads to where I see a squeeze happening. That's how I'm processing it.
Yep.
And just being like, if that happens, I want to have some allocations now when the the longest dated calls you could buy or whatever are basically as cheap as they're going to get. Now,
Right.
does that have to have a lot of things probably align in order to see that magical run? Probably, in my eyes, right? Some people you might not think it's necessary, but in my eyes. So like, I'm trying to think, how do I want to be allocated, like, percentage wise? Do I want my whole stack to be in this thing? I don't personally, but like, I want exposure, and like, it's like, how much do I want to put in it? When do I want to buy that? How am I managing it? So these are all things I'm thinking through as you're kind of walking through this.
Yeah, absolutely. I think there are a couple elements there, and I think actually Andy touched on some of them. But when we think about hyperliquid overall, I think there is a reason why it's diverged from Bitcoin. And we need to ask what that reason is, right? We even talked about that reason previously this year when I said, oh, yeah, hype's going to break its correlation from Bitcoin as HIP 3 comes out. And, a lot of people are like, we've heard this before. Something's going to break its correlation with Bitcoin. Like, it's not going to happen. And I was like, well, no, because every other crypto project gets collateralized with Bitcoin, whereas hype is decoupling in its collateralization and cash flow generation. So that, that's a massive issue or a massive element for the drivers of price action. Here, we have the daily HIP 3 volume as a percentage of total, and it is only going higher, right? In terms of the open interest, we're not even at, over 50% yet. And it's only going to move higher as they list more and more contracts. And then for the volume, we're at, basically the same level, 32%, or same level as open interest and rising of 32%. I just think that in the next four, I think it's shorter because of some other things that I've talked about, but I think that will increase so much more and it'll just completely decouple with Bitcoin completely. If we're decoupling from Bitcoin at 30%, what do you think it's going to look like at 60%? Like Bitcoin could just get nuked and Hyperliquid could actually rally, right? I just think that there's a new system that's getting built right now, and it's not around Bitcoin. I think a lot of it has to do with all of the tokenization laws and perps, and that is the disruptive change in the financial system as opposed to a monetary one, which happened in 2021 and 2020. So, my view is that, like, I just think that Hyperliquid as a protocol and Per as an expression is still really significant. What I would say is that we definitely need to see more action by leadership at Per to capitalize on the potential that they have. Because we already know that Per has more potential than an ETF, right? But the question is, are they going to capitalize on that potential? And I think that's going to be the biggest question to be watching for. I think that people are so concerned with the warrants. The warrants are at, I was just going over the exact numbers again, just so that people know exactly what they are. Warrants are, I get right here, 937, 1250, and 1875. So, we hit the money for one of them, and 1275 is still at an all-time high. And then you have 1850. That's more than 100% higher, right? Like that, those are massive moves, and people are worried about the overhang when in the interim you could have a dramatic shift in the entire market if Per decides to make a stronger play that ETFs can't, especially with how everything is kind of playing out right now. So I think that's such a big element that's really underappreciated, right?
I agree. And if crypto's taught you one thing, it's like people get addicted to vesting and unlock schedules because tokens just continually rain on you in Web3. But, you start to learn sometimes that as the market is understanding more and more of these prices and levels and warrants and unlocks and vesting schedules, that the longer it spends kind of playing near that realm, the market starts to account for those. And you'll often see that in the moment when it actually were to happen, if you would get up to 1875 or whatever it may be, the market may have already digested a lot of that worry or apprehension or whatever, and you can see it start to accelerate from there, which is
Right.
why you'll see a lot of people say like unlocks are bullish, right? Because people sometimes don't understand that the market is smart as a collective.
Totally. Yeah, I agree. And I think we'll go over, we've gone over Per and the entire idea behind it. If people have questions, they just need to rewind this and go through it themselves. Because listen, there's risks and there's reward. There's outperformance for a reason. You get paid to hold risk. And the risk is not just about, here's one of the things that I would say. People are fundamentally misunderstanding on like a progressive basis in kind of the environment we're in, they think that issuing stock is always dilutive or it's always negative. Well, issuing stock dilutes, yes, but they always think it's a negative. If I issue stock, take the cash and put it into asset that goes up significantly more than the cash itself that I was able to raise, that is additive to shareholder value. Like there's a reason why you issue shares because you're able to make an investment where the return on the investment exceeds that dilution that takes place. Like this is not rocket science, guys. Everyone thinks now that like, oh, if anyone's diluting something, stock has to go down. It's like perfect. Keep believing that because that works until it doesn't. And same thing with same thing with all these Mag 7 companies, same thing with Oracle. And I think that we just keep setting up all of this. And I'll go over Oracle really fast because I know that people keep losing their minds over it.
I'm out
Which I,
here battling in the comment streets about Oracle right now.
yeah, I mean, dude, like people are just going to keep, like coming up with the same arguments that they're coming up with. And here is what I would say. If you go back to the original thesis that I laid out, what's the original thesis? This is the risk reward that I laid out, right? And the original thesis, which has not changed actually, it was actually confirmed by the last meeting, is that the company has made a very clear indication that they are not going to go into a high yield investment grade or from investment grade to high yield. So we know they're not going to issue so much debt that they push themselves into high yield. And the market literally right now is pricing incredibly high a probability of a default risk for Oracle, which is like insane because they have a backlog of assets that is so significant that is already, priced in terms of like their ability to one, deliver on it, and two, the demand for it. Like people that think that like, oh, well, there's not going to be demand for compute and data centers and stuff like that. I mean, like I just don't even know how to respond to like an argument so absurd. It's like saying that like the sun's not coming out tomorrow. It's like, have you seen the entire retooling of the entire economy? You know that Anthropic and OpenAI and all those guys, if you gave them the opportunity today, they would just throw billions of dollars at you just to get a little bit more compute. Like, go talk to any of them. Go talk to anyone who is either a large corporation or a small business. Like everyone's setting up their own GPU clusters, everyone's setting up their own kind of thing to be able to bet on this. And Oracle is the one company in the world that is pulling all of the short-term pain into the present. And so notice that when we kind of originally talked about this, we were at the lows here, and I said, listen, like we've priced in pretty near to kind of perfect in a sense, price to perfection for the bearish scenario at these lows, which is why, we rallied up when we had kind of that squeeze in the entire sector overall, which is the IGV sector. So we squeezed up on IGV and then we've come back down. So what I know here is that a lot of this has been sector flows. We haven't even priced the fundamentals in Oracle. Once we begin to price the fundamentals in Oracle, this thing is literally going to converge and go out of the software sector into the hardware sector and get priced like like I mean like all the hardware stocks that are just ripping 400% in like a couple month period of time. I just don't think people really kind of grasp that because the backlog, there's uncertainty about the backlog, but the fact that they have the backlog is pretty insane. And the fact that they're building all of this and they're betting the entire company on it is in itself pretty significant. And again, people want to kind of ignore that because the price is going against them. My view, and again, if I change my position, I mean, the only, like no one has to follow this, right? I'm sharing how exactly I'm positioning around this. And I've said, I got long, right here, down at these levels right here, basically down at these levels, and laid all that out for subscribers on the Substack and have been saying it every single day. I put out another note in the chat. So if you're on the Substack, you'll get all these notes. And we rallied up. And again, we rallied up, but why did we rally up? Can you tell me that? The reason why is because of sector flows, not really because of fundamentals. Fundamentals a little bit. Oracle outperformed marginally, and I think there were some positive things that took place, but we haven't even seen 10% of the actual thesis I laid out play out. And so I've laid out that I'm long spot position, which, as long as we remain above these levels right here and we don't move, below 110, $100 and close below that, then I remain long. And I own 2027 and 2028 out of the money calls because I think that's one of the best opportunities in markets right now because Larry Ellison wants to get this stock to 600, $800, and he's literally compressing the entire company to do that very thing. So this is not, even though we're rallying up and rallying down, those are all positive. Listen, I'm glad we rallied up. Do I wish that we retraced the move or whatever? No, sure, of course not. But the more important thing is how am I getting exposure to the actual thesis that I have, because I can come in and trade positioning and sector rotations all day. Like I do that all day. Like that's something I always do. I'm interested in it. I think it'll keep happening. I think it'll be keeping opportunities. But the entire goal behind Oracle is to say that they have a backlog greater than their market cap right now, which means that they have so much demand and so little supply of the thing that they're actually trying to provide, and that supply of what they're trying to provide is going to come online likely in Q1 of 2027 or Q2 in 2027. So there's a question about how they're going to fund that, whether they're going to issue a little bit more credit or equity or something like that, and the question is how they overlap that timing with the changes in the earnings that they make. And when I see this, when I see IGV and Oracle, people are saying, "Oh, the Oracle thesis is not playing out." Like these are all just sector flows. Like just look at this chart. Like when these are all moving in lockstep. When I begin to see stuff like this, notice right here where Oracle just or excuse me, where you have, or here, I'll show these two things. You have periods of time like this where the IGV sector rips and then Oracle is like lagging. And then you have other periods of time where you have, for example, right here, where Oracle is outperforming IGV and Oracle is literally rallying when IGV is falling. And that is the fundamental flows around Oracle. And so what I'm looking for is the period of time when Oracle is going to not only outperform but diverge. Honestly, in a very similar way that Hyperliquid has diverged from Bitcoin, because they have Oracle as a company has basically divested or sold off, however you want to say it, all of their basically software assets. So now they're kind of, in one sense, a pure hardware play in many ways with this added kind of benefit of memory and these other edges and their first movers advantage compared to some of the other fangs. So, that's my view. I continue to hold my position, continue to hold the per position, and I expect very large moves to the upside. I expect, if it's gonna rally to 300% or more, then I would expect 50% drawdowns to occur multiple times in that, you know, move to the upside, especially if we have a kind of an insane move that, actually moves to, 600, if we go from, 150 to $600 or something like that, like that's let's just say round numbers, 500% return, 600% return, that's a pretty significant return in just the spot price. And my entire goal is to own, it's actually in one sense, you can express it better than per because you can actually buy out of the money calls for 2027, 2028. So, everything is very clear. And I just think it's one of those bets that you just want to take for me. And the thesis could be wrong, which is why I have the risk level, which is why I talked about, like if it ends up being wrong, the calls are going to go to zero. And if I'm wrong on the spot position, I'll take it off and it gets stopped out right here. I mean, that's how this exactly works. And I just think that it is such a significant opportunity, which is why, Per and Oracle are my largest positions.
Also, like, I think people forget that markets are savage and that, like, they will push you to your ultimate limits. Like, oh, you got a great thesis here. You're a little bit on sides. We're gonna slap it up so fast that you're gonna feel like a genius, and then we're gonna reflexively slap it back so fast that you're gonna question everything about that trade. And you have like price and time capitulation, right? Well, price can if it moves this fast, this egregiously against other things that you're looking at or whatever, I can absolutely see your frustrations and how you might want to just take that position and throw it to the woodshed. And then I could also see how we've moved over time through this giant arc since we first talked about the idea and how you could capitulate that way and say to yourself, you know what? I don't understand the point of this time period of like putting my capital there when everything else is moving. But that will happen in every single asset. We're not going to have an up and to the right, no problem perfect thing. That's just again, that's we talk about this all the time. That's not what volatility does. That's not what asymmetry does. And if you're thinking that this is just going to be the easiest thing for you to do, it's just not going to be. And I think this is a great example of somebody getting, ourselves included, being on sides in something, it coming back to your entry or even past where your entry was, and really testing, what do you know about this? What do you know about this asset? Do you really still believe in it? It's putting you to the absolute test while you've given back money. It's easy to come up with a thesis when you haven't lost yet, but now that you've gained and lost a ton of like capital, you then have to re-put your thesis and forge it in that fire. I just think it's like typical markets.
Yeah, I mean, I think it goes back to like, no one was stopping anyone. I know people that did this. No one was stopping anyone from taking a gain right here. Like I never told anyone to like not take a gain or anything like that. I think it was great if you did. If you did, then you can even double down more if you want. But it's easy, and this is why you need to be process oriented and position size, because if we are here and people took a gain and then we just ripped even further, people are going to say like, oh wow, I should have held, like that was my issue, right? And then now we're back down here at the literal highest signal to noise risk level for support, based on fundamentals and positioning. And people are just kind of doing the opposite, which is fine. I mean, like we're all learning here. Like the thesis could be wrong. You could play all of this way better than I do. It's very possible. But my entire goal is to say, like, what's the thesis? How do I take a big bet within that? And how do I pull together all those factors? And this also connects to, we don't when you're in the macro regime, what you want to do is map that so that you can know if there are, if we start moving into a probability of a market crash or a recession, then the most important thing that you can do is begin to put on hedges, get out of trades, begin to cut your risk really aggressively. And, I've talked about this idea of liquidity in the market expanding, liquidity beginning to shift. And people now are not able to think about that because they probably have so much concentrated in a couple positions. And this is really where you're going to differentiate yourself. If you can begin to come back to this and say, okay, we're in the macro regime. We still need to cover kind of the equity risk curve that we're going to go over right now. And if you want this entire slide deck, it'll be available afterward. But when we go to this bigger picture idea, we need to say, okay, what is the overall environment taking place? Let's not take Oracle, Micron, some of these stocks like Bitcoin. Let's not take that. And because you have a large position there, let it begin to distort your ability to interpret the bigger picture. That's where you can differentiate yourself right now. And in this session that we're going to go through right now with this slide deck, the goal is that you'll be able to locate where capital sits on the equity risk curve, read when money and real rates are about to push it toward disruption or towards safety. And that's what you'll be able to do by the end of this quick session. And this is not rocket science, guys. First, see the equity curve not as a category, but as a spectrum from cash flows to long duration disruption. So you want to watch the frontier moves of how is alpha migrating to wherever change is the greatest. So this is really key. One, there's an equity risk curve. Some things are more risky than others. Number two is the riskiest things in the market are always changing. Why? because they're the riskiest things. And so they either don't do really well and they get, body bagged, or they do so well that they change the entire system and become a large company that doesn't have as much risk. And so the idea is that alpha always migrates to where there's the greatest change. AI is clearly having more change in the world than Bitcoin. No one can really deny that. And so that's why you're having liquidity move into AI names instead of Bitcoin. And in a leveraged system, you can't afford to be absent. So if you ask any corporation, any company, anyone, would you rather take, the $10,000 you have this year, put it into Bitcoin, or take it and put it into compute and learning AI so that you can make a product that makes you $1 million? What are you going to do? Like, guys, this is not rocket science, right? That's the constraint that people are under. And so by saying, like, oh, well, the smartest thing you can do at all times, no matter what, is buy Bitcoin. Well, not if you're going to lose your job and get disrupted by AI if you don't spend 10K on some compute and also learning AI. So again, it's all easy to say what you think about, like, oh, the only thing you should hold is Bitcoin or something like that. The only thing you hold is whatever it might be. But when you look at, well, what are the constraints in markets? What's going to force people to buy and sell? That's really where you want to say, okay, people are forced right now to buy AI, to buy these AI names and to retool the economy with AI. If they don't, they're going to get kicked out of the game. So they'll wait to buy Bitcoin. They still have to buy Bitcoin later, but it's definitely connected to the time horizon. And so finally, read the force that moves capital across the risk curve with the quantity of money and the real cost of money. If you can do these things in the macro regime, this is the entire goal is, we're going to go over this in the free macro playbook, but if you can get these first principles really dialed in, then when we move to the paid members section, which we're going to go to in a little bit, you'll understand macro liquidity, the credit cycle, cross-border flows, growth, inflation, liquidity, rates, and FX, all the breakdowns. And if you can't make it to the entire thing, there'll be a 20-minute report that you can read every single day that breaks down everything for you. So let's start. Equities are a curve, not a category. There is no single stock market. Capital arranges itself along a continuum of risk from cash flows now at the bottom to long duration disruption at the top. So if you think about the difference between buying, a dividend stock that pays you 6% every year and a VC investment that doesn't pay you anything and might not work, but it could pay you a ton of money in 5 years. That is the entire idea of a risk curve. Some things have more risk because the cash flows are farther out in the future. The bottom of the curve is defensive, dividends, short duration earnings. You get paid now, low beta, low drama. The slope between them is the risk premium. So if you have a 6% return on a dividend stock or 8% return on a dividend stock or whatever that might be, and a VC investment might have a 10x return, or let's say a 2x return over a year and a 10x return over a 10-year period or something like that, then that spread between them, that slope between the return, is about the risk curve. And so the idea here is that you have the lowest risk stuff getting paid now, defensive, cash, money market funds are the lowest risk. And then you have frontier things or higher risk things, which is long duration disruption. And you always have this slope that's changing on the risk curve that is always going to shift how capital moves. And so you don't want to just say, is capital moving into these names, but what's the slope between them? And so when you begin to quantify this in real time, a very clear example, and everyone kind of gets this, is high beta versus low volatility basket. Here's the names on the long end of the risk curve versus the low volatility basket, which has positive returns. It's done all right, but it hasn't done incredibly well. But these are all lower risk. These are, people would initially think like, oh, well, these have gone up more, so like I should just buy those. Well, if you want to take more risk, yes, but think about what happened during the drawdown in 2025 when all the high beta stuff went down the most and the low beta stuff just, barely moved. Like, these are all the things that people in markets and the largest players in markets are thinking about every single day. And if you want to be able to take advantage of the opportunities in markets, you have to start with what are the people with the most amount of money that moves the market the most thinking about and doing when they are taking actions. That's where you need to start instead of saying like, well, I have a really good process for drawing lines on this chart and looking at these Fibonacci levels. Right? Like that might be helpful, but you want to ask hard questions and say, who are the people that move markets the most? What impacts them? How does that connect to macro liquidity? And so, another example of just, growth versus value, that's one of the ways that we'll look at things in terms of near term versus long term cash flow. The top of the risk curve is never the same names, though. Alpha does not sit still. It migrates to whatever is producing the most change and disruption. So the frontier of the curve is constantly reforming around new leaders. Just think about how all of the leaders in 2021, they're no longer the leaders today. It's very different. All of the beneficiaries of lockdown, the digital world. Just think about, this is, just basic examples like Zoom. Everyone thought, oh yeah, Zoom is going to be the next greatest thing. Just absolutely rips in 2021. What does this go to? We had, one of the I remember, this during the time from the lows.
That was
We
crazy.
went up
Crazy.
720%, and now if you held it during that same period of time, you'd be up 23. So all that, and then you go back to from the highs to the lows, you're down 90% basically. Are you going to say like, oh, macro liquidity is increasing? Let me get long Zoom. Sure, if you really want to, get long and try to get long from the lows and stuff like that. But you think about what names are going to do the best in this period of time. You want to do that, or what's the name that's doing the best in this cycle? Right? Obviously, Nvidia, which is up 1,000%. Whereas, oh yeah, you could have bought Zoom. It's up, 50% from the lows if you bottom ticket and if you top ticket. Whereas Nvidia, you have a lot of variance and you can be up, if you don't bottom ticket, if you don't top ticket, you're going to still be up 800%. So the names on the frontier are always shifting. They're always shifting. And so last cycle's leaders become this cycle's kind of laggards, and the names at the top rotate always. So being absent from the frontier is in itself a position, one that quietly bleeds while the leaders compound. So you have to remember this is that no action in itself is a risk. And when you think about the idea of taking risk in today's world where change is so prevalent and so fast, you can't afford to not take risk. You need to ask yourself, just by sitting around and doing nothing, what risks am I taking? And we often think because nothing bad is happening that we're not taking any risks. And so all the money in the system has to sit somewhere. And cash is decaying as an asset. Capital is forced out the risk curve to find a real return. And so, on top of all of that, the idea of leverage makes all of these moves even more violent and reflexive, and everyone wants the same seats. And so, when you think about the frontier overall, you have the last cycle, that's what's taking place. Now you have semiconductors, energy kind of move things around, but allocation is always relocates to maximum disruption in a leveraged system. You can't afford to not be on the frontier. And so when you have things like cap weighted versus equal weighted, this is one of the things that benefits from the frontier on a marginal basis. That's why being long market cap weighted versus equal cap has upsides and downsides. And when we think about leadership, this is the type of divergence that takes place. Semiconductors up this amount, you have energy, maybe that moved up just a little bit during the invasion or the Iran thing, but we've moved back down and we're still below these levels. Broad market is still at these levels. This is what it looks like to have all of the names on the farthest end of the risk curve having disruption. However, here's a kind of wrench that we can kind of throw in all of it. Usually on the farthest end of the risk curve, it means that it has earnings that are farther out. This time around, all the names on the farthest end of the risk curve are printing cash. So It's not like the tech bubble where they're saying like, oh, well, we might make money in 5 years. It's a situation where we're asking a question about, we already know that they're going to make money and they're going to be fine. The question is, how much are they going to make and how fast is it going to take place? And that's what multiples are about right now. So, with that in context, liquidity decides where you sit on the curve. So, again, when people talk about liquidity, they pull up all these fancy charts. Just ask them how it connects to the equity risk curve. If you can't connect it to the equity risk curve and the returns in the S&P 500, then like basically talking about liquidity is worthless. Just doesn't matter. Changes in nominal and real purchasing power, which are about the quantity of money and the real cost of money in the system, are the force that push capital up and down the risk curve. So the nominal channel, more money in the system has to find a seat and it pushes up the curve toward the frontier. So, for example, think about stimulus checks when they got injected into the system in 2021 and 2020. That pushed capital out the risk curve. Even if that money was spent on groceries and it wasn't spent on stocks, that money finds its way into the financial system eventually because think about it. You take that money, let's say you spend it at a grocery store. Part of that money at the grocery store goes to other people who have, let's say, a 401k or some other factor that gets taken out on a marginal basis. And then that money flows into the stock market. Some of that flows up to all the corporate representatives who have a lot of money in their 401ks, and those flow into the stock market. And so all of that on net can have massive changes because when incomes in the economy increase, part of that flows into one, the banking system, and two, also, well, it's in the banking system, but it flows into the financial system. And so changes on a nominal basis flow into the financial market. That's why you can actually take some of the money that you have and put it into your brokerage account. That's nominal changes impacting financial markets. The real channel is falling real yields lift the value of distant cash flows so that the top of the curve re-rates the hardest. So it basically means that when you have it incredibly cheap to take out debt, more people start to re-rate investments in the system. Just think about 2021 when inflation ran hot and the Fed suppressed rates. Real rates went negative, which, you know, pushed so much money out the risk curve because if you basically held a money market fund at the time or US treasuries, you basically lost money, which is why in 2022, when we re-rated that, you had a market crash. So leverage is the amplifier because the system runs on borrowed money, marginal liquidity shifts, move everything at once. This is, by the way, people talk about leverage as such a nasty, evil, bad thing. If you didn't have leverage in the system, you wouldn't have any of the innovation taking place. Like you want leverage in the system. In many ways, if you do it right, leverage actually helps you take less risk. And especially in the system overall, there's creative disruption that takes place, and people hold portfolios of debt and equity, which allows them to diversify some of their risk. And when they take out leverage, it actually it enables them to many times take even more positive expectancy if they don't get over leveraged and have an asset liability mismatch. So again, saying leverage is evil or bad is like saying that having a car is like bad because it gets you to where you want to go faster. It's like, what are you talking about? Like, just don't drive recklessly. Like, it's not it's just a total conflation of things. And so when we look at liquidity moves on the curve, when the money supply changes and you have cash flows that are in the short end, and you have those changes can reverberate across the entire risk curve to the long duration cash flows. Excuse me. So when money goes into the system, capital climbs up the curve and money goes out, it retreats and leverage makes it more violent. That's the idea. So when you have the reserve level, or there's a lot of different factors right now. For example, the yen is down on the day. That's one of the reasons why equities are up. Japan is exporting a lot of liquidity into the global financial system right now that again, people don't want to recognize. Yeah, anyone who's mapping liquidity or trading rates knows that they probably shouldn't short equities right here because with the yen moving down like this and how the carry trade is adjusting, like the worst thing you can do right now is short equities. Maybe that changes, but first you need to see the signal of that changing. And so The real cost of money is an important thing to watch. We'll talk about that in the paid subscriber section. But high risk equities have rallied incredible amount ever since we have this higher step up in basis in the Fed balance sheet. But notice that the Fed balance sheet has been moving down and equities have still rallied and increased their valuations. And the question is, how exactly is that connected? How does that connect to the carry trade, to this larger macro liquidity impulse? And that's one of the things we're going to cover in the paid subscriber section, which is what we're going to move into in a moment. But the idea is that you understand how the equity risk curve functions. You understand the real cost of money and understanding real interest rates. You understand that liquidity is always going to move around depending on where the most disruption is taking place. And you want to always look at where are the leaders concentrating? How are those relative to the rest of the market? And then how do you begin to make decisions in light of that? And so you have the fundamental basis for those mechanics. And again, every single educational idea we lay out on these live streams, they'll always be free in the macro playbook section so that you can synthesize them together and be like, all right, now I have a clearer understanding of what's taking place. And then if you want to begin to synthesize those with the actual things taking place in markets, then you can join the paid members section on the Substack. But before we jump into the paid members section, I really want James to kind of pull together more of these pieces and connect them to how you want to think about these macro liquidity factors, not just in their quantitative and fundamental components, but also in the mindset you should have for approaching them.
Yeah, so I had an interesting conversation with a buddy of mine the other day where he's testing some new stuff in prediction markets. And he's doing a lot of these binary plays with Bitcoin price and different assets in there. And he's concerned because he's well off, and swings from his long-term portfolio don't seem to really bother him. Yet he's been coding up with Claude and testing these different things in prediction markets, and losing like 25 bucks on a bet is like eating away at him like crazy. And I just thought, with the comments out there today with Per and Oracle, again, by no means are we saying that it's like trading's easy or belittling anybody or whatever. We're just trying to help think through risk with a better framework here so that you could outperform moving forward. But I thought this was a really interesting thing to talk with him about, and how, why is it that he could lose 50 grand on his long-term portfolio over 6 months and not really be worried about it. Yet he loses 25 bucks on a random Tuesday morning, and it eats away at him for the rest of the week or whatever it is, right? And I just thought that was kind of fascinating. So I thought through that a little bit more and kind of came to the idea that a lot of it is just the distance you've put between yourself and the results. And most people, I would say, have been able to kind of distance themselves from their investments because of the mindset we've entrenched in everybody for this long-term investing, DCA, benchmark mindset. But to shift towards more of a short-term trader, swing trader, allocator, guy who wants to find severe outperformance, go towards volatility and everything, it's a process and a muscle that you need to work. And I talked through that with him. So I threw this deck together, right? So it's like, I don't know if this applies to any of you guys out there, but I'm going to guess it does. Why is it that the same loss, might move you to the core in one account, but then in the other account, you don't really care about it too much, right? And it's not necessarily in like the specific edge you have in this market compared to that market. Rather, it's your distance to those markets and your central nervous system's ability to react in a positive way to that. So in his case, again, this long-term idea is something that like he has seen before. Over his 20, 25 years of investing, he's seen things go down, go up, go down, go up, and he's able to kind of handle this idea of losing a percentage of his net worth on paper and then being at a high watermark on paper over and over and over, to the point where It's very normal to him. But he's just getting into the streets of prediction markets and faster trades, scalping, if you will, back and forth binary type of things. And when he loses even a small amount, he is just absolutely not used to volatility in the short run, right? And just like anything, if you're not practicing the reps, if you're not incorporating this into you, you can't just expect to go from one time horizon to another bucket and just be. Actually, it's funny that I say this because this is the reverse of me, right? Is I was trying to go from short term to long term and having my own struggles there. And in his case, it's going from long term to short term, which I think most people are, like, especially a lot of you that are showing up through X right now or YouTube or Substack. You guys have, maybe you're working a job or whatever, and you've been able to DCA into your investments, or like you want to take more of a grip on your finances and your portfolio allocation now. So you're starting to shrink your time horizons. Maybe not for everybody, but for the ones who are, you're probably running into these things where these shorter term moves feel so much worse to you in the moment because you don't have the reps. You haven't really come face to face with the violence of volatility in the short run, and you've been able to dull it by zooming out effectively, right? So it's less about the money and it's more about the distance itself. You know, if you just like kind of zoom in on this little spot right here, this could just be a minus 12% move that he took a flyer. He made a bet on a meme coin, a sports bet, whatever it may be. And in that moment, the fact that you haven't dealt with this before, you haven't taken reps there, you don't understand the risk associated with it, you don't have a network built around it, you don't have a process or a harness. This is going to feel like you're just going to feel so dumb here. And that's kind of what he's battling is he's like, why did I even bother doing this? You know, why did I even try to make this trade? Why am I creating this bot? Blah, blah, blah. And the reality is his bot's performing pretty well. But even so, when it goes on a downswing of like 5, 6 trades in a row, it's eating at him and making him question everything. But really, it's just like his nervous system is not ready for it and he doesn't have any reps. So my suggestion to him was, sizing down, getting more reps, adjusting accordingly under the point where your nervous system is going to take over the reins and you're going to start having it guide you rather than you guiding it. Right? So most people are going to try and mute volatility. This is something we talk about all the time. Long-term investing is the only strategy. This is the way for you to just never have to feel risk, right? Which I have my own opinion that will be put to the test at some point here in the next 5 years. And I mean for every single person out there. But for now, we have had this kind of decades long suppression of volatility and an entrenchment of an idea that if you just zoom out and think about your long term thing, 65 years old, you'll be able to hit the eject button and all will be well. But, if you're stepping into that short term and you've turned that volume all the way back up and you've not developed your calluses, you haven't gotten the reps in there, this is going to be a very hard process for you. Again, I want to bring in the archetypes here because I just feel like it's always so important to think about, as you're adjusting to this, who are you as a trader? Because if you're the elephant or the owl, that the longer term defensive people, right? Where so elephants, they're going to be able to hold through time and huge drawdowns, and it'll be fine. It's they're not even blinking. But if they're crossing over into the short term, every fast move they make is going to feel like a wound. They're going to freeze. They're not going to understand what they're doing. They're going to be like, this isn't me. What am I doing here? Why don't I just go back to what I know best? Owls, same thing. When they go over, they want to know everything about what they're investing in. That's like their thing. Paralysis by analysis becomes the threat to their livelihood. They're not going to be able to come and do short-term scalping in the midst of a volatile environment and expect to know everything about what's happening. Foxes, they are the people that play amongst volatility, but when they try to go more long term, they're the ones who can't sit still. They're rotating, they're chasing the next shiny object, and they're just going to get diced up in the meantime. And then the bulls, I think this is a lot of the archetype people want to become. They want to be the leader, pushing the momentum, massive outperformance. But, that can lead to oversizing, revenge trading, and it can turn into just absolute catastrophe. So again, if you haven't watched my video, go to my YouTube channel, go watch the 4 archetypes video, just type in the word archetype there. It's just my full name. And you could go learn about which one that you actually are. I think it's good. It's a very simple procedure, and you could learn a bit more about yourself. I think it's very worth your time. So, just a simple visual for you guys to think about it is the oops, the less volatility you want, the worse your performance is likely going to be, right? So if you guys don't want, you want to be comfortable, you don't want to have to think about much things. Maybe you're going to be looking at the benchmark, right? That's the invest in the VUs and go on vacation and just keep working your job. But as you walk, right, as you try to rent some more volatility and you go towards it, your expected returns can go up. However, like we talk about in PER and Oracle all the time, while you go up that volatility expansion curve, maybe it's a network adoption curve, whatever it may be, as that grows, you're going to have massive divergences on the upside and the downside. And if you're willing to inhale that and accept it, you're going to be the one that could probably um, outperform over a significant amount of time. But you have to decide where you want to be on this curve. I try to be as aggressive as possible. I feel like with the people I'm around, the knowledge I have, I should be taking more risk than the average person. But there could be people in different life circumstances that absolutely should not. So that's something you need to be thinking about at all times. But something we talk about here is that most people are not going towards that obstacle. They're not going towards volatility as much as they maybe should be. And the system and the mindset and the overall narrative is that that's the wrong place to go. And because of that, we think that's the exact right place to go is towards the volatility, towards the premium. And if you could start to build yourself up towards the ability to deal with it, you're going to be the one that gets the fruit of that. So, how do you do that? Okay, like I think what you need to do is work on sizing down, first of all. Sounds simple. I know a lot of people can't do it until that variance is not really bothering you, right? Maybe you could just trade for $1 on chain or whatever it is and start just playing around to learn these new time horizon tactics. Then you start to push the boundary up to where you start to really feel each position, and then as you make more reps there, you're going to expand that like a breath in a balloon over and over to the point where you can handle the volatility and handle the swings to where your long term positions and your short term positions might just kind of be balanced internally, right? So bank some reps, define your risk before you enter. And then this is my favorite, like expect to mess up, expect to feel a catastrophe inside, expect your central nervous system to not be ready for what you're going to experience. That's okay, but don't fall prey to it. Just be aware of it and accept that that's going to happen. So you want to be judging all of this by the process rather than the P&L print you make on that trade. If you could keep sticking to this process, keep banking those reps, keep expanding your volatility balloon within yourself, you're going to be able to just absolutely move into that shorter time horizon pretty well. So, don't that flinch that you might feel in these negative moments for you, you want to train it just like you want to train any other muscle. Pick that time horizon that you're moving towards, cut your size, earn some reps, and stick to your process. So hopefully for you guys out there, this helps. If you're in Per, if you're in Oracle, if you're in crypto, if you're in anything that's like going wildly up and down, maybe start to think about time horizons, how you're approaching it, and what adjustments you can make moving forward.
Yeah, I think that's so good. I think what really stuck out to me is earning the right to have another time horizon. I think that's so good because I think you have this idea of like earning the right to take a risk, right? Like, don't try to take a home run swing until you bat a couple singles, right? Like make up some money and then you can actually risk more once you've already made some money. You don't have to risk your principal. You don't have to take a big swing to risk your principal. And I think that idea of earn the right to take another time horizon is really good because trading across multiple time horizons is very challenging. I think people just think like, oh no, I just adjust the moving averages and keep going. It's like, no, no. I mean, it sounds easy, but then once you take this entire, it always seems easy in the moment. It's actually kind of funny. I was watching what one of the podcasts with Jocko, and he was just like, "Oh yeah, like Buds always seems easier when you like watch it because you don't recognize that like, oh, you have to go run up this berm, and you think like, oh, I can run up that. It's like, well, yeah, but yesterday you just did hundreds and hundreds of pull-ups. The day before, you just ran 10 miles a day. The day before that, were in the water all day and you were just doing nonstop. And now you're coming to the end of the week, your body is cooked, and now you have to like carry this log. And everyone's like, oh, you just have to carry a log. Like, why can't you guys do that? Like, it looks simple, right? But you don't understand that it comes in the context of being fatigued or being, taking all of these, mental or emotional swings on your portfolio. And now you have to make a good decision, even though you've been kind of body bagged around in the arena a little bit. And so I think that having humility and approaching that way is going to be incredibly instructive for everyone, right? Like you have to learn the fundamental side that we're talking about, but then also take that and kind of the glue that holds it together are these exact concepts that James was laying out.
Yeah, I think it's a balance between knowing like thinking you've earned it and like knowing you've earned it. Cause there's a lot of people out there that win a few trades and they're just like, all right, let's roll. Like I got it. I figured it out,
Yeah.
And sometimes that's the worst thing that could happen is for it to work out super fast, where then you size up and move into a different time horizon and you just get axed. And I think there's you need time, you need experience to really be able to sit there and self-reflect and be like, no, okay, like uh, it's been 2 years for me now, and I do not think I'm proficient in 6 month plus stuff, right?
Right.
Like if I was just invested in QQQ right now, I would be outperforming myself by a long shot. So I can't sit here and say like I know what I'm doing. Um, I would say I'm learning a lot. And I've definitely taken good reps, and I've had to size down. So I'm growing my muscle in that arena at the moment. And just like working out, you you go hard in the gym, and you're gonna have some days where you're just gonna be cooked, and the muscles are strained. I'll tell you that.
Yeah, and to give people a little context, James is saying like, he previously just traded on a short time horizon, right? And then you've shifted
Yeah.
more recently to this. And I feel like there have been like, I mean, a lot like it's learning how to take those bigger wins and the losses and stuff like that, and learning how to adjust to those. Because I feel like that's the adjustment, right? Or maybe you can talk to that a little
I
bit.
think I think what I've realized is with long-term stuff, I go too hard. I think too big, right? And some people don't think big enough, but I think too big, and I let the P&L guide me rather than me guiding the P&L. And when I was a trade I got yeah, so if you don't know, I was for 11 years a futures scalper, right? Up, down, around all sorts of assets, any commodity you could think of, softs, energies, metals, bonds, currencies, whatever. Um, didn't matter long or short. I'm in there for 10 seconds. I've been there for 10 minutes, maybe a whole day, who knows? But I just was so agnostic to like direction and price and all that. So I got used to just banking, banking, banking. That's what I did. And I was confident that I was going to find more and more opportunities. Now I contrast that with now, and I just keep thinking to myself, I have to be in these for a long time. And like sometimes I just like hold on too much, or I'm a little too sloppy with my entry. And and then the price is so much bigger and more violent for my net worth that the price ends up affecting me too much, and I cave to the moment. And because of that, that means I'm overexposed. My time horizon might need to shorten up a little bit. You got tax implications that come into play. So I'm constantly adjusting at this moment. I'm like, oh, I'm going to need to learn more about the macro regimes because like that's going to factor. The longer you add into time, that's going to factor into my positions more. I didn't give a shit about the macro regime when I was trading live cattle for 30 seconds on a Wednesday, right?
Right.
But for Oracle, when it's dislocated from IGV, I just tweeted that. and I want to play this position for the next 18 months, that's a whole different trade,
Right.
based on so many different factors that we've been going over day to day. So
Totally.
always a learning process.
Absolutely. I accidentally set the timer too short on Twitter, so the stream just stopped there. But we're gonna, so I want to wrap up here, and we're gonna go into the paid section. But for everyone who is just kind of getting the idea of like all these moving parts and how it works, we're gonna transition into the paid subscriber section, which is going to be exclusively on Substack. So if you want to be on that section, it'll stop on Twitter and YouTube, and then you can go to the paid subscriber section on Substack. We're going to continue the live stream there. And then we're going to take all these different ideas and really connect them to, okay, how should we think about interest rates right now? How should we think about inflation? How should we think about macro liquidity, the changes in the yen and everything like that? We're going to go over those momentarily. So we'll take a quick break, and then we will be streaming just on Substack.